Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Game Plan for Retirement with Chris McIntire. McIntire Retirement Services, Northwest Ohio's retirement planning resource.
And welcome into the program. This is your Game Plan for Retirement with Northwestern Ohio's resource for a common sense approach to planning for our financial and retirement futures. He is Chris McIntire, president and founder of McIntire Retirement Services. Chris, welcome back in.
Hey, good morning, Peter. Good to be with you. Good to be with everybody out there. Hope everybody's staying safe out there.
Always a pleasure, Chris. We appreciate the time, the guidance, the perspective that you provide. Northwestern savers and investors have counted and relied on the guidance from McIntire Retirement Services to help them achieve their important financial goals. And ladies and gentlemen, if you've got questions or concerns, you are welcome to be in touch if you're serious about planning for your financial future. Chris McIntire is your resource as well and willing to give you individual direction and guidance. All you need to do is pick up the phone and give a call, 800-868-1194. That's 800-868-1194. You can also visit online, McIntyreRetirementServices.com, McIntyreRetirementServices.com. When we are looking at our financial progress, Chris, a lot of us want to have some type of metric for measuring performance and seeing how much progress we are making. This may be a mistake, and the way that a lot of us sort of measure that up seems to be something that we compare to others, we compare to indices. Maybe it needs to be more of an individual type of comparison to our personal goals.
Sure. You know, we get a lot of folks that will say, hey, how are we doing compared to the S&P 500? And you need to realize, is that the right comparison? You know, because that's 500 stocks. If you're in 40% bonds, 60% stocks, then you don't want to compare yourself to an all stock indices, you know. And so, you know, trying to be relative there. Yeah, I think a better way to define it is, you know, what's your range of expectations in, you know, given your overall risk tolerance. And, you know, we're going to highlight some of this on the show on some of the notes that we talked about before you turned on the record microphones. And we'll give some great examples of, you know, some folks that have made some very emotional type decisions at their, to their peril, I guess.
Absolutely. Well, I know that a financial advisor can help people to really avoid some of those emotional mistakes. But as we try to gauge our progress, whether we're comparing it to our friends or neighbors or coworkers, whether we're comparing it to an indices, the S&P 500 or the Dow Jones, something that we see on TV, that can be a bit of an unfair comparison because it really depends on our individual goals and objectives. If our goal is for a higher rate of growth, we are taking more risk. But if the market turns downwards, we can't say we're underperforming because we didn't preserve and protect our portfolio. At the same time, if we have aligned our portfolio for preservation and protection so we don't lose a lot, we shouldn't expect to make the returns of the S&P or double-digit returns when the market is up. So it's really an individual type of decision. But Chris, that is really the conversation that we have with advisors and why we need to balance the emotion of investing with our goals and objectives to make sure that they are in alignment.
Absolutely, Peter. And it's, you know, an analogy that I'll give you is of a client about my age, 55 years old, lives out of the state. So we don't have to, he's not tuning into our show here. But you know, he and his wife are incredibly conservative. And, you know, despite a record recovery in the stock market, they're still sitting in cash, just that nervous about investing. And, you know, so, you know, the opportunity risk that you take by, you know, trying to, you know, completely dodge the storm, you know, it's hard to, you can't completely miss things, and time the market's an impossibility. And, you know, that's why you do a well-diversified portfolio designed around your overall risk tolerance. And, you know, that allows you to weather some of the storms and not make emotional decisions like, all right, I'm going to pull my money out. I'll figure out when I want to get back in. And, you know, our folks at Brookstone Capital Management have some nice white papers out there that talk about missing the biggest days of the year of the stock market and what that does to you over time. And, many of our clients are not 100% in stocks. They shouldn't be. They're much older. They have different risk tolerances, but, for growth opportunity, that is a place to help grow money over a long period of time. And it certainly can get emotional. Obviously, back in the month of March, Peter, as we saw the entire world shut down, basically, that drove a lot of emotions. No question about it, for everybody, myself included, you too.
Absolutely. And if we let our emotions guide our decisions, the day-to-day market movements can feel like an out of control roller coaster. And that's why a financial professional can help you address and overcome those emotions and make rational decisions despite those or in spite of those emotions. Overconfidence, despair, those happen as we ride the ebbs and flows of the market, as it goes up and down, as we hit these all-time highs. A lot of people have a great deal of confidence. As we saw it crash 30% back in March during the height of COVID. There was a lot of people that had despair. Oh no, is this going to be another 2007, 2008? How much financial progress and how much time am I going to lose? But again, having that plan in place is what helps you navigate that. And Chris McIntire is your resource, can help you make those decisions, lay out a plan that makes sense, regardless of what the market conditions are. And then as the market conditions change, continue to review and update and monitor that plan and the investments in that plan accordingly and in reflection of current conditions. If you'd like to have that type of resource, pick up the phone, give Chris and his team there at McIntire Retirement Services a call, 800-868-1194. That's 800-868-1194. Chris, when we make those emotional knee-jerk reaction decisions, those can potentially be pretty costly. One big one is impatience. If we aren't willing to sort of wait things out and wait and see, impatience can be a very costly mistake.
It certainly can. And, a good example here, Peter, would be, this stock I bought last week isn't doing what I wanted to do, and I'm going to chase the next one over here. Sometimes you call that yield chasing. And, so frequent trading would be, one of the, the impacts of being very impatient. And, the unintended consequences that's going to have for you is probably lower returns, because I'm dissatisfied here. I'm going to try something over here. I want to, get on that ship. Tesla would be a good example here this year. They've had a, rising like a meteor, and, heck, now they're worth more than the Ford Motor Company, for example, by the, if you took all their outstanding shares of stock times the stock price, they're worth more than Ford Motor Company, and just amazing the growth of them. And a lot of people are jumping on the Tesla bandwagon. And, nobody knows if it's too early or too late. That's not what we're saying here. But, after they've been up 150% or something like that, and then start buying them. So
right.
It's momentum. Yep. Momentum can be a risk as well for folks.
Well, I mean, I'm guilty of this one as well, Chris. There have been plenty of times where with my Play Money account, I've made a purchase and I was like, hey, this is positioned well. This is valued at an opportunity. This is going to go up. And so I make a purchase, and for the next 2 or 3 weeks, it goes the wrong direction. It goes down on me. And I get out. I can't help it. I lose my patience. I get out. I don't want to lose any more money. I rethink to myself that, hey, maybe that was a mistake. And then as soon as I sell out of it, it shoots way, way up above the original purchase price. And I could have made a whole lot of money. I didn't have the patience to stick with it. And unfortunately, that was an emotional mistake, even though my original intuition was correct that it was probably valued at a good price. I didn't maybe catch it at the very, very bottom, but I was close to the bottom, and I just didn't have the patience to stick around till I made profit, and it ended up costing me money.
Absolutely. And, but the point that you made is that was with your play money, or what a lot of people call it, this is my mad money account. When I lose it, my wife gets mad.
Right. Yep. That's it.
And I do the same thing, Peter. I've got an account that I don't mind playing with and whatnot, but it is not part of my, the bulk or where my retirement plan is. That I don't do much trading on whatsoever. I didn't trade and get crazy defensive through this down market or anything like that. I'd let that ride, because you never know when it's going to turn. This year, the Federal Reserve came in early, came in heavy. And, that is what's helped fuel this stock market rally. It's not really the economics behind it. It's that the Federal Reserve said, hey, we're going to come in and put a temporary floor in here until we get things, back up and running. And, by and large, we're certainly on the road to recovery here. And it's going to take a long time. This was a big hit, obviously. And, what they said was 15 days to stop the spread has turned into 6 months almost.
Yeah. Well, Chris, I am not a buy and hold and hold and hold forever, nor am I a day trader. But I think that the impatience, it causes people maybe to trade more frequently, and to try to get those quick hits, quick winners. And what it costs investors potentially is higher costs and lower returns. And this is cited through a Dalbar study. Dalbar is a leading investment research firm, and their 2017 quantitative analysis of investment behavior studies the investor experience versus the returns of the index. And it showed that in 2017, the S&P returned 10.2%, annualized returns historically over the previous 30 years. And the performance of the average investor was only 4%. So a 6.2% difference in returns over that time, largely attributable to probably the knee-jerk reaction decisions made by impatience. And by the way, Dalbar has conducted this study every year for the last 30 years. They've shown about the same thing.
Absolutely. And, it's funny, the market is very efficient, and individual investors are very inefficient by nature. The market takes care of itself. So many people, the market doesn't make emotional decisions. People do. If you don't think that's the case, go drive down to the local restaurant. Look how many different colors of cars are in that parking lot. If we didn't make those types of investments, there'd be one color of cars.
Well, investment professionals, Chris, they can help you build and maintain a disciplined investment plan over time. A steady investment approach generally outperforms strategies that rely on thoughts of the moment, impulse buying, and market timing. Another big emotional mistake, Chris, overconfidence. And we sort of feel that euphoria when the market is doing well, but that's really the time that we should be more cautious.
Peter, this is an area where I think, too much information, TMI, plays into it, because, we can watch Kramer on CNBC in the morning and at night. We can watch Maria Bartiromo on news channels. And, we're on Motley Fool, we're on all Yahoo Finance, all these different areas with so many different types of investments and choices to make. And, I'm going to put a stop loss to it. I'm going to, put all these other pieces into the puzzle that, at times may be to your advantage, at times may be to your disadvantage. So, trying to play off of hot tips is hard. And I mean, I get emails on this all the time. So this is a big one here, being overconfident, playing on hot tips, because what can happen here is your risk of large losses can happen.
Yeah. Be careful relying on the experts to pick the winners, or believing that you have some kind of information that others do not have. Chris, there's a theory called the efficient market, and it essentially says that all information that's available is already priced into the market. It's hard to pick winners or losers, and we know things are cyclical. And just as an example, stated in the report that you brought to my attention, the best performing asset class in 2007 had a 39% return. Guess what? 2008, it was the worst performing asset class, lost 53%. So be wary of chasing performance and returns, and work with that financial professional to select investments based on strategic planning rather than hot tips of the moment.
Absolutely. A well-designed portfolio adjusted with your risk tolerance and, your rebalance on a quarterly basis is certainly a better roadmap than, taking the temperature and seeing which way the wind's blowing every day.
How about fear, Chris? Do you see fear leading to people missing good opportunity?
Of course, and we hear the analogy FOMO, F-O-M-O, the fear of missing out. And that's what, we talk about, like a Tesla, for example, this year would be a good example of that. Some of the, you and I are recording on a Zoom right now. That's been a very hot stock, the fear of missing out on that all right, and nobody's going to go back to the office if we get some successful treatments, and Zoom's going to continue to grow and grow. But for a lot of folks, that fear is, the example I gave at the beginning of the show. I've got a client that is still sitting in cash, doesn't just so incredibly nervous about investments from what happened in 2008 to his parents. So he's making investment decisions today off what happened to his mom and dad 12 years ago.
Chris, would a reasonable solution be to ease back into the investment experience and into the markets instead of all or nothing? Maybe consider like a dollar cost averaging strategy to help you address and overcome fear, but also get the market exposure and the growth that we need?
Oh, it makes perfect sense to me. And, but he is just so crazy cautious about this that missed some incredible opportunities over the course of time. And, and even here, the stock market's at record highs. And I got a text message like, boy, too bad I, made the choices I made when I made them and everything. So, his fear is, okay, now if I get back in, the market's going to go back down, which is why it's hard to say, I'm going to get out now, I'm going to get back in later. Those types of things are hard because you never know when it's going to turn. So again, waiting too long to get back in if you've gotten out and you miss that rebound. So opportunity cost, again, gets you on a lot of these things. That's what emotions typically do to people in the investment world. This is not like buying your next house. That's a big long-term investment. A lot of people will get into an investment piece like Peter and I were talking here on the overconfidence piece. I got in on a hot tip, but that tip didn't work out. I'm going to cash out here a week later and I lost 10%, that type of thing. And that's usually a pattern that repeats itself.
Well, again, if you need help in making these decisions, in formulating the plan, in executing the plan, to make sure that you're not making emotional mistakes, knee-jerk reactions that could cost you big money over the long run, pick up the phone and give Chris McIntire and McIntire Retirement Services a call, 800-868-1194. That's 800-868-1194, 800-868-1194. Chris, another big one. We saw this absolutely as at the onset of the COVID pandemic and the economic shutdown, a lot of panic. It's that momentary, we're swept up in the moment, we're panicked, and we end up making some decisions that could come back and haunt us.
Absolutely. And again, this would be, maybe, I'm going to sell into cash. I've gotten a number of emails from clients here that, hey, should we get into cash before the election? Like, all right, well, and kind of my reply to that is when we have conversations to them, okay, what does history tell you about what happens during presidential election years?
Every presidential election, Chris, is the most important election of the time, and every one is always different than all the others in some form or fashion.
Sure, and history tells us that it really doesn't make a difference in our overall, regardless of the results, regardless of the presidential results.
This one's different, Chris. The fate of the world hinges upon this one.
I certainly have heard that, and we've had many of those conversations, and we'll avoid the political discussion here, but history tells us that it doesn't make that much difference. And should we get into cash? Is the stock market going to crash? No, those are political talking points. That's all that those items are on, and let's blame both parties for that.
Yeah, absolutely. Well, again, talking about emotion, certainly as we tie in other conversations like politics, we can get heated about that. We can certainly get emotional, but again, emotion tends to lead to investment mistakes, not well executed and thoughtful planning decisions. And that's why we're talking about these. It has been proven through studies. The Dalbar Institute, which studies investor behavior, has shown for the last 30 years consistently and back testing across time that the average investor, mostly due to these type of emotional decisions and mistakes, significantly underperforms the market and therefore leaves big money, thousands, tens of thousands, hundreds of thousands of dollars on the table in lost opportunity over the course of their investment lifetime. And to help you navigate that, a financial professional can show you measurable benefits. And Chris McIntire willing to have these discussions with you, help you stay calm, maintain your long-term approach and focus. Talk to your financial professional. Chris can certainly help put current market conditions into perspective, give them a call, 800-868-1194. That's 800-868-1194. Chris, another big one, as you discuss, what may or may not happen in the future. How do we know? What decisions should we make? Indecision, another big emotional roadblock to executing a well thought through plan.
Correct. Let's say that you panicked and sold into cash, and now your decision is, or indecision is, when do I get in? How do I get in? And like Peter said, when we have folks that come into us that say, hey, I just inherited, a couple $100,000 from my parents' estate. It's in cash at the bank. How do I invest that? And oftentimes we will put that money in over the course of time. And depending on the size of the nest egg we're dealing with, how long it takes us to put that money into work. But even, we do that every week at our office is, okay, let's put out of this $100,000, for an example, let's put $20,000 back into some dividend paying stocks over the next 4 months instead of all in one lump sum, just to, take out worrying about timing the market, if you will, dollar cost averaging, which is a wonderful way for folks to invest over the long haul.
Well, again, teaming up with a qualified financial professional can help you have a more disciplined approach to your investment strategy. When faced with uncertainty and market volatility, working with a financial planner, a professional who is qualified to help you navigate those times can help you make sure your objectives, your strategies are top of mind, and you'll be better equipped to ride out market volatility and uncertainty. Chris McIntire offers you that opportunity. It begins with just a conversation over the phone, over the computer, virtually, or in person. That review and that strategy session is designed to help you have a discussion, uncover issues in your planning, help you understand the risks that you're taking, the fees that you're paying, the taxes that you may be liable for, how you are positioned. Does it match up with your true risk tolerance and in your financial progress and your timeline with where you appropriately should be positioned? How much do you need to retire? Are you ready to retire? How can you translate and transfer that lump sum that you've saved into the income that really retirement will be about? Chris McIntire can help you address all of that in a retirement review financial strategy session. Pick up the phone and give a call, 800-868-1194. That's 800-868-1194, 800-868-1194. Chris, financial advisors' biggest job really is to help keep clients on track during times of uncertainty. And we have to acknowledge right now really is a turbulent time. There is a lot of uncertainty out there that the average investor probably is being pulled emotionally in a lot of different directions.
Oh, no question about it. And just if you simply watch the news, you can see where, there's a bull on one side, there's a bear on the other. So, people get this tug of war. Do I get more defensive now? Do I get more offensive now? If I listen to Bill, he says this. If I listen to Susan, she says that. Who's right? Well, a broken clock is right twice a day. So again, well-diversified portfolios built around your risk tolerances, will serve you better. And, I think the traditional knowledge that as you get closer to retirement, an approach on being a little bit more conservative so you don't have those large drawdowns. And like Peter and I have advocated on this show for coming up on a decade, having a plan B in case plan A does not work for you. And we have always been strong advocates of, safe money strategies.
Well, I think three parts there, Chris, that will help your clients navigate those turbulent times. One is technology that is available to you as a financial professional. You can harness the power of technology, maybe work through some tools and use some calculators that the average investor probably does not have access to. Your focus on long-term planning and your ability to help people balance the protecting what's important versus seeking opportunity. And there are certain times when each one is most important, and you help people balance those two very different goals.
Absolutely, Peter. We deal with, a wide variety of clientele that have, different goals, different aspirations. They come to us with different stories, different histories. a lot of them will have behavior characteristics that their parents had, like we were talking about with, I got a client that's still making decisions based off of what happened to his mom and dad 12 years ago. That's hard to overcome. So, how do you manage those expectations and, deliver results that they have? You have to tell them what they need to hear, not what they want to hear.
Chris, how much of this emotion do you think is driven by the lower interest rates? How much is this in fact a risk to investors that they are being pushed to take more risk because of these low interest rate environments that we have been in for the past 15 to 20 years?
I'm so glad that you brought that up, Peter, because it does have a factor in things because, we have folks every week that call us up, our clients, people from the radio show saying, hey, I've got money at the bank. I'm not earning anything on it. They're offering me 0.5% for the next 5 years. And, should I put that money back in the stock market, or are there other safe alternatives where I can at least maintain my purchasing power? And there certainly are. And Peter, as you know, we've been doing this for many years, helping people reposition safe money into other safe places. And we also help people reposition some of their risk money into safe places that can still deliver a competitive rate of return, possibly, structure some income out of those pieces, but have a different, a different objective with the safe money. So for example, if I've got a portfolio here of $500,000, I just using a round number, and I'm in stocks with that, that's my aggressive money. But if something happens to that, I can come over here to my safe money and still maintain my standard of living, take pressure off of my risk money and let it grow and recover then. And, that's having a plan in place just in case something bad happens, planning for the worst. And if anything else happens that's not as bad as what you thought it could, hey, just icing on the cake.
Chris, there are options and alternatives for principal protection that are offering more growth than those traditional bank accounts, savings, checking, money markets. And there's actually even like kind of a spectrum on the safer or at least more conservative side of the financial world that allows people to gauge what kind of safety they would like. Complete absolute safety, likely probably not going to lose money, but still on the conservative end of the spectrum that really can have a wide range of different rates associated with it and the opportunity for much more growth than what those bank style accounts are offering at this point in time.
Peter, we have been advocating this and we've had a very good year helping people reposition these types of assets and find some of these opportunities that they did not know existed previously. These aren't things that just fell out of the sky in 2020 to help rescue investors. Long tried and true concepts that have been around for a very long time with some of the largest corporations on the face of the planet that have been through world wars, and recessions and depressions and all of those, and all of the different things that can happen in history, let's say.
Well, again, we have talked today with Chris McIntire, president and founder of McIntire Retirement Services, Northwestern Ohio's resource for a common sense approach to planning. We talked about ways that investors measure success and whether those are truly fair or justified, whether we compare to a market index or compare to our friends or neighbors or coworkers. It is an individual comparison based on your specific situation and your goals. That is the measure of financial success. We talked about how investors can have emotions drive decisions, and oftentimes, unfortunately, that leads to inefficiency in the portfolio or planning mistakes. And that's why it's good to have a disciplined, long-term plan and a financial professional to help keep you on track and hold you accountable with that plan. We talked about the emotions behind these low interest rates, and then on the other end of the spectrum, the market volatility. But there are options, there are alternatives, ladies and gentlemen, where you can get a more reasonable rate of return, where you can have principal protection or income protection for retirement. If you'd like to find out about these, pick up the phone, give McIntire Retirement Services and Chris McIntire a call. Part of the value of this program and of you tuning in is the extension of this information to personal application. You can take Chris McIntire up on the offer for a complimentary individual financial and retirement review and strategy session. If you'd like to do so, all you need to do is start with a phone call, 800-868-1194. That's 800-868-1194, 800-868-1194. Similar reviews to what Chris McIntire offers, the depth of the analysis that he will go into, the time that he will put into planning can easily go upwards of $1,000 to $1,200 for that time and that planning effort. Chris makes it available to listeners to this program with no cost, no obligation. Pick up the phone to take advantage. 800-868-1194. That's 800-868-1194. And Chris, we know that you've helped so many across Northwestern Ohio, from Perrysburg to Fremont, Port Clinton to Norwalk, savers and investors who are taking their planning and their financial future seriously. Count on McIntire Retirement Services, and we'll continue to count on McIntire Retirement Services no matter what the economy and the conditions of the market bring into the future.
Well, Peter, it's a good to be with everybody out there. I hope everybody's staying safe. We're getting some good news on some therapeutics and the blood plasma and some vaccine information. Hopefully we'll get that soon here. So stay safe, everybody. It's our pleasure to be with you folks.
Always a pleasure speaking with Chris McIntire. He's looking forward to hearing from you, helping in any way you can. Give a call, 800-868-1194.
Visit McIntyreRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Indexed or fixed annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charges as described in the annuity contract.